Wall Street rarely talks about it. But the U.S. dollar isn't just a currency, it's a global weapon. Since the Trump administration, hidden policies have quietly shaped how money moves worldwide. From tariffs to corporate tax changes, these decisions affect banks, investors, and currency exchange. Today, we break down the unseen forces influencing the dollar and global markets. This is not speculation, it's based on real policies and financial data. Let's start with corporate tax reforms. Trump-era cuts allowed U.S. companies to hold more cash domestically. This increased liquidity in American banks, indirectly influencing global lending. Banks could now extend more credit abroad, creating a ripple effect in emerging markets. But it didn't stop there. Trade policies also played a role. Tariffs on China, Mexico, and Europe redirected capital flows. Some markets gained, others lost, often before the world even noticed. Currency values shifted quietly, giving savvy investors early advantages. Now, let's look at the Federal Reserve's interaction with these policies. The Fed controls interest rates and liquidity. Trump's policies amplified their impact, creating hidden multipliers in the market. Banks with strong reserves benefited the most. Smaller banks and emerging market lenders often faced tighter credit conditions. Currency markets reacted differently in Asia and Europe. For example, the euro strengthened temporarily while the dollar stabilized. This created short-term arbitrage opportunities for investors. Private equity firms and hedge funds acted quickly. They moved money before mainstream investors even noticed. Understanding these hidden flows is crucial for global finance strategy. Next, let's talk about off-balance sheet arrangements. Some banks kept assets hidden from public reports. This allowed them to move capital discreetly across borders. The result? Some institutions gained massive leverage. While others appeared stable, they were exposed to unseen risks. Emerging market investors often bear the brunt of these hidden moves. The lesson: not all liquidity is visible. Now, let's break down how trade wars affected currency exchange. Higher tariffs on Chinese imports made the yuan less competitive. Meanwhile, U.S. exports remained strong, supporting the dollar. Global investors began shifting portfolios in response. Commodity markets were also affected. Oil, gold, and metals fluctuated. These movements weren't random. They were linked to policy signals. Smart traders noticed early patterns and profited. Let's now examine corporate liquidity overseas. Companies took advantage of lower taxes to repay debt and reinvest abroad. This shifted capital flows in unexpected ways. Countries dependent on U.S. credit felt the impact first. Some regions experienced currency tightening. Others gained temporary advantages. Investors with foresight could hedge against volatility. Now, a quick look at bond markets. Trump-era policies influenced Treasury yields and interest rate expectations. Bond traders often anticipated dollar shifts before anyone else. This created both risk and opportunity in global finance. If you follow these patterns, you can predict short-term market reactions. The key takeaway? Global finance moves in layers. What you see publicly is rarely the full picture. But the story doesn't end with U.S. policy alone. Global banks also respond to indirect signals from Washington. When tariffs or tax changes are announced, banks adjust lending strategies immediately. Investors watching these moves gain insight before financial news reports it. This makes early knowledge a powerful tool. Now consider foreign reserves. Countries holding large amounts of dollars are affected by U.S. policy quietly. They may adjust their holdings to stabilize local markets. This subtle shift impacts global currency exchange rates. Even small fluctuations can affect trade deals and commodity prices. Multinational corporations also react. They hedge their foreign investments according to these signals. This keeps profits stable even during currency swings. Now let's talk about Wall Street's hidden tactics. Some investment firms use predictive modeling to anticipate policy outcomes. They analyze tariffs, tax changes, and Fed announcements in real time. This allows them to execute trades milliseconds ahead of competitors. The result? Some firms gain millions before the public even reacts. Emerging investors rarely have this advantage, but understanding policy patterns can level the playing field. Next, let's explore derivatives and hedging strategies. Corporations and banks use derivatives to manage risk from these policy moves. This shields them from losses during sudden currency changes. Investors can also learn from these strategies. Observing derivatives markets shows where capital is moving. Now let's examine real-world examples. During a 2018 tariff announcement, the yuan fell and gold prices spiked temporarily. Early movers in commodities and foreign markets profited significantly. Meanwhile, casual investors saw little change until it was too late. Another example is corporate repatriation of overseas cash. This injected liquidity into U.S. banks and strengthened the dollar temporarily. Hedge funds anticipated this move and adjusted their portfolios accordingly. Now consider the impact on emerging markets. Tighter credit from U.S. banks forced some countries to raise interest rates. This slowed growth but created arbitrage opportunities. Savvy investors capitalized on currency mispricing. Wall Street's insiders act quickly, but you can learn the patterns too. The lesson? Watch policy, liquidity, and capital flows together. They tell a story the headlines often miss. If you understand this interplay, you can anticipate market shifts. The Trump administration left a legacy beyond visible policies. It shaped global capital behavior for years to come. Investors who study these hidden influences gain a significant edge. Next, we look at corporate repatriation policies. Tax incentives encourage companies to bring overseas cash home. This strengthened liquidity in U.S. banks. It also temporarily boosted the dollar. International investors tracked these movements closely. Bonds and equities reacted to sudden cash inflows. Markets adjusted faster than news outlets reported. Now, let's explore derivative trading. Traders who understand policy signals profit repeatedly. The public reacts only after shifts occur. Now consider emerging investors. Observing patterns allows strategic planning. Hedging, derivatives, and timing become tools of advantage. The lesson is simple. Knowledge equals power. Understanding policy, capital flow, and currency moves is key.